Welcome back. This is the 12th session out of 14 for Ensuring Success 2025. We're so happy that you're here with us. I have just a little bit of housekeeping, and then we'll get right into the topic matter. The first thing is, if you have any questions for our speakers, you can put them in the Ask a Question box, which is down below the window where you're watching me right now. And that we'll get that information here on the set. If you have any questions for our tech team, like you're having problems seeing the video or sound is choppy, or if you have any questions about CPE, our tech people are standing by. You can reach them. If you look at the top of the screen right above this window, there's a email address, info@ensuringsuccess.com. There's also a phone number you can text to. So if you have any questions for our tech people and need an answer, that's where you would contact them. Ensuring Success would not exist without the generous support of our sponsors, and they include ADP, Avalara, Canopy, CPA.com, Digits, eFile for Biz, Field Guide, Carbon, Count, WriteWorks, SafeSend, SureLink, ValueInsights.ai, Walters Kluwer, and Xero. And this particular session is sponsored by ADP. For those of you who are expecting CPE or CE credit for this session, here's the way it works. 3 times during the session, we'll take a short break. At the bottom of our screen, we'll display a 3-digit code. So three codes, 3 digits each, 9 codes altogether. 9 numbers altogether. So you'll need to, each time we display one of those 3-digit codes, you'll need to write it down. And then at the end of the session, at the end of the day, whenever you're ready to claim your credit, you can go to the CPE/CE credit option on our menu bar at the top of the screen. That will take you to another screen where you'll be asked to enter the email address that you used to register for this event. If by chance you're watching this and haven't registered yet, and enter your email on that screen, it will say you haven't registered yet, and it will lead you through the registration form so that you can be registered. And then after that, you'll be taken to the CPE screen, which has a button on it that says claim your credit. And what you'll do is you'll click that, it'll open a screen that lists all 14 of our sessions with spots for you to fill in those 3-digit codes that you write down each session. You'll enter all the codes for all the sessions you attend, and then there's a button that says to download your certificate. You'll click that button. Even if you're just here for CE credit and don't really want a CPE certificate, you still need to click that button, that download button, that enters your information into the system with the codes that shows you were here, and then we will dispatch your information off to the IRS. Okay, this is session 12, and it is the One Big Beautiful Bill, corporate tax reforms. One thing we want to do during this session is try to answer as many questions as you might have about the corporate reforms that are in the Big Beautiful Bill. So we welcome you asking questions in that Ask a Question box, just open-ended questions about something that you're interested in or concerned about regarding corporate reforms in the Big Beautiful Bill. So go ahead and enter throughout the session, enter any information you want to there. Our expert panel for this session includes Michael Smith, Lynn Muchensky-Keck, and Vaughn Long, and my co-moderator, Alexander DeFelice. And so I'm going to have each of them introduce themselves real quickly, and then we'll get started. Michael?
I'll go first. I'm Michael Smith, one of the directors of tax for ADP, also a CPA by trade and training, was in public practice for 15 years, but been with ADP not once but twice now for over 15 years. So it's good to be back with Gail and team.
Lynn.
Hi, everyone. I'm excited to be with you today. My name is Lynn Muchensky-Keck. I'm a national tax partner with them. I'm in charge of the National Tax Service Group and monitoring federal tax policy.
Fun.
So my name is Vaughn Long. I am an enrolled agent. I own Tax Solutions Alliance, but I also have a second firm, Allied Tax and Accounting, that's focused on advisory, small businesses, accounting, payroll tax. And I feel like I'm the lucky one at the table because these are the experts. I have so many questions from my clients as we plan out what BBB is going to do. So yeah, this is great to be here. I appreciate it.
Excellent.
And I'm Alexandra DeFelice, Chief Marketing Officer, Chief Marketing and Business Development Officer for, it's been a long 2 days. I forget where I work, JMBM law firm in Los Angeles, here for all 14 hours with Gail, co-moderating, ringing the bell, and helping you get CPE.
And speaking of which, when we do post CPE codes on the screen, you will hear this bell. And that's your sign to look up. Make sure that you get that code and write it down.
An angel got its wings.
There we go.
All right, so we're going to dig right in here, and we thought we would start with the R&E expenditures. And I have to say, what happened to R&D credit, and now it's R&E? I'm not sure. It's all the same thing, I think, but
Yeah.
Michael, take it away.
Yeah, I'll start us off. So R&D is used, interchangeably. And a couple of things. We'll talk about some very big, inputs from OB3 this time. But the basic criteria for R&D credit has not changed. Again, any business can qualify. It's a general business credit. It's an activities-based credit, heavily based with payroll and wages and so forth. Any business meet that 4-part test, develop a solution, a product, be in one of the STEM sciences, be a new method or design to your business, and have a process of experimentation.
Wait, now, have they added accounting yet to STEM sciences?
Not yet.
Okay.
One day.
Working on
day.
that. But there were some changes. So, Lynn, do you want to maybe start us with a history lesson on where we are and where we're going? So, it's
Sure.
important.
Do we have 2 hours?
Yeah,
Yeah.
I'm going to keep it. I know we got to keep it short. We have so many
So easy.
things to take care of in the next hour. But 174 obviously is linked to the R&D credit. The one thing about the R&D credit that's really exciting that a lot of people might have not learned yet is that next year, this year we were supposed to have quite a bit of documentation process for the R&D credit, and the IRS has postponed that 1 year. So a lot of people are excited about that. And then the other, history of 174 was, it was very odd to us when people said to us, we can no longer deduct research and experimental expenditures anymore as part of the TCJA Act. And that's because it was a budget reconciliation bill and they needed to bring revenue back into the system. So no one actually ever thought that was actually going to happen. And then it happened, and we all were quite shocked that we were now starting in the 2022 taxable year, 23 and 24, we're capitalizing our domestic R&E over 5 years and our foreign over 15 years. The one thing I always say to people, don't forget, foreign is still capitalized over 15 years. So if you have foreign R&E, you're not out of the woods yet. But as the only economically developed country who didn't allow R&E to be deductible 100%, they did change the rule under the OBBA. And so now, essentially, if you're a small business taxpayer, which is similar to all the gross receipts tests that we're used to, you look at 25 and say, were my 24, 23, and 22 average gross receipts less than 31 million, then you can go back and amend for those 3 years and immediately drop it down to the bottom line. Or alternatively, you can take any of the amount remaining that has yet to be deducted, and you can immediately expense it in 2025, or you can spread it over 2025 and 26. And we were having a conversation about why would anybody do that, right? And so we had a lot of, somebody can feel that one because it's a common theme of what we'll discuss today.
I think it's also important just to interject and point out that, the amortization, the required amortization too, actually pumped up a lot of taxable income and tax liabilities. And for small to medium-sized businesses, it could have been perceived as punitive. They may not have had the money or the cash or did not want to pay the extra tax. And so fortunately, there is some of this relief in the new bill. And then for, again, small businesses, average of 31 million of gross receipts or less, you can go back and do those amendments and perhaps get the cash back, those refunds back. So that's very important. And we're going to overlay this also into bonus depreciation, because as you know, I just got asked that question on Tuesday at another forum, and it's like, Lynn, I was asked what would I do between bonus depreciation and R&D credit. So you want to maybe you or Vaughn talk a little bit about the enhancements, which is another embracement that everybody's seeing.
Yeah, I think the first thing I want to stress, and then I'll toss it over to talk about bonus depreciation, is before the TCJA, all of us didn't care, and we would get it done all in 1 year and drive the loss negative, right?
Absolutely
We would say
right.
we'd have loss after loss after loss, and who cares, because we can carry it back, right, 2 years or for 20 years, and there was no taxable income limitation. I think what everyone needs to realize at this point is that's no longer the case. And if you're driving your client into a significant loss position, you're not helping them.
Correct.
Because next year when they carry that forward, they're only going to be able to offset 80% taxable income, which means they're going to have to pay cash out the door of 20%. So the new reality with that NOL limitation rule is that we're trying to match our revenue with our expenses pretty much online. And because of that, that's why we might say, well, we don't want to immediately expense all our R&E expenditures in 2025. We might want to spend them over 2025 and 26. And then to your point, and Vaughn can come in here, and why would that matter with bonus depreciation?
Well, even with the bonus depreciation, I find myself going back and attending here before the importance of an advisory practice in general, right? So we were struggling with our practice. We had volume clients. We're trying to get things done as quick as we can, struggling with these conversations. And this just reiterates the reason of sitting down and planning this out. Where am I trying to take it immediately? Where do I want to capitalize these things? And it's if you don't have an advisory practice where you have time to sit with your clients, this is getting lost in the shuffle, and it's going to be a surprise to a lot of practitioners. So the bonus depreciation is the same thing. It's got to weave in together. And, our firm with smaller clients, it's in this definition, small business is 31 million or less. I think in my world, a lot of times small business is gross revenue of 2 million or less. So am I having enough conversations? Are there R&D situations? We already talk about bonus depreciation all the time with these clients, but R&D wise, are they doing things that we can look at? And then how does this blend together? And that's where we're really taking it with our firm.
Yeah.
I think that's important. R&D, before you move on, is the single largest business credit that's out there under general business credit. And only 1 in 3 businesses are actually taking advantage of it. And oftentimes in part of our practice, our average, business size is probably 10 to 20 employees. So, it's, again, not industry specific, it's activities based. So it's very important. If you have clients out there that you're asking the questions, what are they doing to innovate? What are they doing to remain competitive, maybe grow market share? Even non-traditional businesses we're seeing develop or pay to have apps developed that may run their business better. So there's just a lot of that activity. And Lynn, to your point too, is, there may be some other reasons you need to plan and have those conversations. Vaughn, as you mentioned, be that advisor when you're out there discussing this. Right, going into the compliance season, so.
Mike, I would say if you're not modeling for your clients and you're just throwing everything in the kitchen sink in, they might knock on your door in a year or two and not be so happy. But I would also, similar to what we saw with the immediate expensing of 174 and being able to spread it over 2 years, there's a lot of options with the bonus depreciation. So previously, before OBBA came out, bonus depreciation was only supposed to be 40%, right? Which was a really low figure considering our history with bonus depreciation. And fortunately, the OBBA came out and said, hey, if you, and I'm stressing this on purpose, acquired, not placed in service, but acquired property before January 20th of 2025, you can't take the 100% bonus depreciation. And so it's not a place in service test, it's an acquisition test. And I think that's something I see oftentimes missed. I would point out it's based on binding written contract rules, which we all had experience with under the tangible regulations. But going forward, right, you might say, well, Lynn, I don't want to apply 100% bonus depreciation. And you might say, okay, well then elect out. And hopefully everybody remembers we elect out by class and we can elect out in a variety of different ways. But they're also for the first year only, so for the 2026 taxable year, they allow you to say, okay, let's think we have a 5-year asset. You don't want 100%, right? You don't want 20%. Can I still get the 40? And for 2026 only, they allow you to elect in and only take the 40%. So I think it's really important, again, when we're looking at all those levers to pull, on how to, decrease revenue to zero but not go below, there's 3 different options right there in that one provision alone.
And just blend it in. QBI. Ooh, do we need to wait on that one? That one's going to be a big one.
Yeah, we're going to take just a quick break.
Perfect.
Okay.
All right, we would like to have a quick commercial break, a message from our sponsor, ADP, and then when we return, we will display the first CPE code for this session.
Let's also forget.
And we're looking here too.
We are back. If you look at the bottom of your screen, you'll see the first CPE code for this session. So be sure to write that down if you're planning on getting CPE or CE credit for this session, and there will be 2 more codes later on. All right, where were we?
Well, look, my clients live off of QBI. So
Okay.
one of the big changes is this made that permanent.
Yeah.
We've all been waiting for this shoe to drop for years of it's going to expire, it's going to change tax planning. So, I just thought that was a huge win that came out of this, and just thoughts on this. There's not much to it other than just nailing that. But
And that's for the qualified business income.
I'm sorry, yes.
Right.
Yep,
199A.
yep, 199A.
And I just want everyone to know that was not an easy win. Okay?
Easy win for small business practitioners and so on. Like, we would love to see that happen.
No,
right?
I love to see it happen, but I'm saying there was a lot of fighting. I was
not
out
surprised.
there. I was with representatives. I think the biggest challenge we had was, I think 90% plus of people who actually put TCJ in that realized why we should be allowed the 20% deduction were not there when we passed the OBBBA.
Wow.
That's incredible.
And so we had some people saying, oh, it's a loophole for partnerships. It was really an education system where we started a year and a half before to explain to them, this is a parity issue. The corporate tax rate dropped to 21%, and we need this 20% deduction for our pass-through entities. We shouldn't be penalized just because of the entity type that we choose.
Right. So,
Well, it was years we just didn't. We weren't 100% sure. We were guessing at rates. Would this continue or not? So having some resolution on that. Yesterday they did a great job popping through some of the BBB on individual side, but tips and overtime and how the reporting is going to work for business owners
right.
is one of the top questions we're running into at any conferences. So.
Yeah. It's, and I'll just start out by saying, for 2025, the law's fairly clear. It's just use a reasonable method, so as I have people calling and whatever, it's like, just, relax a minute, let's look at the law. 25, keep doing what you're doing. 26, we are expecting more guidance. And if we do get some of your questions in, which I know Alexandra is tracking, we may say we just don't know yet because we're still waiting on a ton of guidance. Everything was shut down for a while, so that delayed some things. But yeah, definitely the tips and, the permanency. When I often think of OB3, I think about everything in many instances was made permanent, so you don't have the redundant, so a lot of these credits were made permanent and so forth, and we clearly don't have time to go in a lot of depth. But, on the tips, again, things to think about. The systems, the payroll systems will be there, I think it's the integration. Maybe if you got a point of sale equipment is one of the easiest ways, perhaps an app. Can always use a spreadsheet. We all like spreadsheets. We all like paper, so you can still do that as well. So, but it is coming. I think there'll be more guidance. But I think also just talking about, as we look at the tips and you look at some of the other credits, we talked about, whether you're exempt or not or characteristics of that. So
yeah. So I think there's a lot of misnomers out there, right? And so one of the things, the first thing I would highlight, especially from an employer side, is you're still paying Social Security, right? And you're withholding taxes on that tip amount or that overtime amount. That is not helping you at all. What is probably happening is you're getting a little headache of how am I supposed to track this? And from an employer perspective, they said, you know what? For 2025, as Mike pointed out, we're not going to assess penalties for a misapplied W-2 or misinformation. They do recommend attaching a statement.
Right.
Good luck with that.
Yeah, which I was just like, no, not recommended
That's not gonna happen.
by some other people. Who knows?
Sometimes less is more,
Less
right?
is more.
Less is more in many instances. So.
But I think some of the things that were overlooked were you have to be classified in a tip category, right? Many accounting firms might have thought, oh, well, maybe I should be paying my younger staff.
That idea went past everybody for just a
Yeah.
split
Correct, right?
second.
They were just hoping for a second.
Yeah.
But you have to be identified to a particular business, and now they've put out those roles that you can be identified with. And then personally, I think the tips are kind of a headache, right? Because we're sitting there saying, well, if you have a mandatory tip, you serve a table of 10 people, that doesn't count as a qualified tip for federal income tax purposes. If you have a little key card and you allow them to tip 10, 15, or 20, if they tip 10, no qualified tip. If they tip 15%, 5% tip. How in the world are people going to track that? So just a lot of misunderstanding and application. I agree, there has to be more guidance that's going to be coming out. But unfortunately, January 1st, 2026 isn't that far away. And we need to be talking to our clients about this.
Not only is January 26th coming up, you've got the government shutdown putting people behind doing this. We've got tax season on the IRS. We've got the cuts in May affecting that prep. I think we're going to be mid-26. If they drop guidance in the middle of tax season, most tax professionals are not even going to know, right? So you're going to pick this up post-tax season, really post-May 1 for all of us, right? When you get to that window. And so navigating this, I loved your point about it's a point of sale conversation. It's not necessarily a payroll service question, right? How is that data on the tips being fed through and tracked? It could be, you mentioned the flat rate. Service charge can be called automatic gratuity. That's the unknown part of this. Kitchen staff different from wait staff. These poor owners are just going to start pulling their hair out and coming back to the tax professional, their accountant, their advisor, and go, what do I do to handle this? And that's where the spreadsheet comment came initially, right? Like I just have some idea.
And that's where, again, some businesses may consider a tip for a table of 6. It may be a table of 8. If you have a larger party, maybe there's a service charge. Well, is that construed as a tip, or is that just a service charge? So there's a lot of questions that we're hoping the guidance will answer when it's delivered. So there's just a lot out there. I try to reassure people for 25. Just go with what you've been doing.
Correct.
You get a pass, so to speak, and so it'll be good at the end of the day.
So I have a question for both of you, and this is something that we ponder a lot. In 2025, there's no responsibility on the employer, right?
Right.
But I might be doing someone's tax return, and they have all these tips in the box noted, and they tell me all those tips qualify.
Right.
Can I say that they got to pass the laugh test? That's the reason. In our firm, we have a laugh test scenario. Like, come on. I mean, from a ratio standpoint, we're going to look back at 24 and see what that ratio was, right? Having a conversation, the last thing you want is to take a chance of identifying yourself with something so far outside the norm that it flags.
Yeah.
And now we can't get into the IRS sides in a couple sessions, but from this perspective and whether they would pick up on it is, hey, fit within the norms, fit within the ratios.
Yeah.
And that's the conversation to be having.
And it's even harder with overtime comp because that's not even a separate box.
Yeah.
So overtime compensation, I think, for the 2025 year will be challenging as well. But we've had a discussion of what are we really looking at for overtime? Is it state or federal focus?
Right.
Yeah.
Yeah, go ahead.
You go ahead.
No,
I was prompting you there.
There's a lot. And again, that goes, are you exempt, not exempt? That's the Fair Labor Standards Act. So just be sure. Again, 25 is what it is. We're coming up on the end of that. Use those reasonable methods. The same thing, before I forget, you talked about the laugh test, Fawn, on the tips. Same thing, reasonable compensation for like S-Corps, things along those lines. What's out there, what will not. I do think more and more guidance is coming on all of these issues to be aware of, and so that the employer can kind of get it right. If you have opportunities, just like the tip credit or other ways to do tracking. The draft W-2 form I've seen for 26 has some of those drop downs, like for the tip and the overtime. So I'm assuming those are near final forms or whatever.
Yep.
So
Yep.
we'll see how all that play. But that's 26, right?
Yeah, not
They're not
25.
redoing 25. So you have to be aware of that. So.
Absolutely. And I would just stress again what he said. The overtime compensation is not based on your state. And if you're in California, ignore, because it's totally different rules.
Different rules every state,
It's
right.
based
Yeah.
on the Federal Fair Labor Standards Act. And so if you don't know that, which I'm comfortable to doing, I'm saying
Right.
I can tell you it's not based on your state. It's based on the Labor Act. Go ask your labor attorney. So that's something that you can kind of help them with as well.
That's good.
Let's take just another moment to hear another message from our sponsor, ADP, and we will return with your second CPE code.
I'm actually looking at the research and development expenses. There's been no change to the actual program as it relates to the criteria for qualifications. However, under the old law, there was this requirement for amortizing those expenses, perhaps over 5 years if in the U.S., or over 15 years if outside the U.S. The new law provides some relief in order we can go back to the actual immediate expensing of R&D costs, particularly if they're in the U.S. If they're outside the U.S., there's still that caveat that they must be amortized over a 15-year period. Additionally, and importantly to note, is that for the years 2021 through 2024, small businesses, and small businesses are defined as 31 million or less in gross receipts, they can actually go back and amend the returns and do the immediate expensing. For larger businesses, they may be able to take the credit or the remaining deductions over a 2-year period.
And the 10% on the tips.
Welcome back. If you take a look at the bottom of your screen now, you should see the second CPE code for this session. So be sure to write that down if you are planning on receiving CPE or CE credit for this session. All right.
Well, we had a follow-up.
Yeah,
So
we were talking while we were breaking.
We were. It never stops, right? So I think there's going to be a temptation for a lot of owners to do the quintessential, I'm done with W-2s, I want to put them on 1099.
Right.
And I really wanted to kind of segue briefly into this because the way it's IRS is a little slow right now on the whole 1099 W-2, but the states are not. States have realized this is a moneymaker post-COVID to really hammer home who should have been a 1099, who should be a W-2. And I'll throw it to you all. I'm seeing in these audits that it's guilty till proven innocent. You know, we watch Law and Order, you're innocent till proven guilty. It's the opposite. Everyone's a W-2 unless you can truly prove you're a 1099. So my fear is there's a temptation. I'll just skip all this and put everybody to 1099, but there's some major challenges. I know in the state of Virginia where I am, there's civil penalties that go with these if they catch you, $1,000 to $5,000 each situation.
Whoa.
That's at the state level. So just thoughts on what you're thinking on that world.
Well, I'm just going to add to another reason people might want to say I'm not a W-2 and I'm a 1099 is, unfortunately, if you're earning tip income from an SSTB or those bad 199A businesses like lawyers, engineers, accountants, consulting, those tips don't qualify. So somebody might say, I don't want to be an employee anymore because I can't do the exclusion. I'll speak from a federal perspective. It is still very relevant, right? As to whether you're considered a 1099 worker or an employee, and there's significant fines and penalties if you misclassify.
Absolutely.
The one thing I always go back to is who has direction over the employee, right?
True.
If you're not directing them and telling them how to do their job at the end of the day, but instead you're giving them an overall task and they're allowed to decide how and when and et cetera, how to complete it, you're probably pushing more towards a 1099. But I will say it's not that easy. But I give that example because if you're sitting there and you're telling them exactly what to do, when to do it, and then you're 1099ing them, that probably doesn't add up.
Yeah. And I would just emphasize, that where we are kind of in the labor market in general, there are perhaps more mature workers that are retiring and then they're returning to those same businesses, as a 1099, but, they may be returning to their same office phone number, title, and so forth. So, you do have to kind of ask that question when planning. And I think I mentioned during the break, to y'all, and because I had this question asked by a CPA, they were like, well, some of my clients are coming to me, they're setting up new businesses, and they're going to 1099 themselves. So, do y'all have some recommendations on yes, no, how to look at it? Just look at the classifications to be sure, or those are some of the planning techniques y'all
Some of the
good at?
easy ones, if you're 1099 and a social security number these days, you've got a big red flag over yourself, right? In the audits, if you're an LLC with an EIN, that's just being set aside for maybe a future conversation. We're going to go down the list of the names. They'll often ask, all right, let me see the copies of the invoices from this 1099. Was that getting paid? How was that being tracked? How many other clients did they have? But you won't always know that question as someone who's paying a 1099. I don't know how many clients they have. I know but if they're there 40 hours a week, if I'm controlling all these things, those are the most common questions you're seeing at the table. And you're right. I know it's a federal focus, but the energy out there is state unemployment, state tax departments. And it used to be thought, well, once they were done, they'd let the IRS know or the federal or the Department of Labor. You're just not seeing the boots on the ground that you used to, maybe back to some of the cuts. But everybody's now just terrified of the state approach because there's just so much money in it. And one of the other downsides is you're seeing with a lot of states when it comes to, now, should have been a W-2, is they want to reassess the tax you should have taken out to the employer. And once they do that, there could be double collection of tax because if that individual reported the 1099 on a Schedule C and did that, the state already got the tax. But because you don't have power of attorney for both sides, the business being looked at and the individual, I can never prove that it's occurred. And most individuals don't want to have a conversation when they know the old business is being audited for W-2 1099. So that it's just going to come back to LLCs and EINs. That's the rule of thumb, 80-20 rule. If you're not paying someone with a 1099 and it's in a business with an EIN with their own insurance, it's an easy automatic no from the states.
Well, there are some specific questions coming in, and I'm going to switch and have you
Okay.
drive here because I think that there are some that are a little bit too specific.
One of them I had myself as I'm listening, just like you all. When you're talking about tips and the 10% choice, 10, 15, 20 didn't qualify. Was there any background on where they came up with 10 not being? 'Cause I'm curious.
Yeah, I'm sorry. I should have been more
No,
clear.
it's good.
So in the example, it was if you go, let's say you go into XYZ, choose a restaurant, and you see on the pin pad when you're asked to tip, there's only 10, 15, 20. Then you're starting and you're saying whatever the lowest percentage is automatically not a qualified tip because you didn't allow them the ability to tip at 0%.
Right.
And so anything above the 10% is deemed qualified, but to the 10% is not. So sometimes it's just changing your systems to say 0% tip. So now I can look at the full amount to exclude.
Okay, so if we have the option of 0, then 10% is okay?
Yes.
That's a huge takeaway. I've not heard anybody else share.
Yep.
Credit to you on that one.
Yeah.
Another one on here talks about.
I can go ahead and ask
Yeah,
it.
would you mind?
Yeah, sure. Do you expect another tax bill? What? That's weird.
I'm queuing you up.
Tax bill? No, it's like it's
We've talked
weird.
about this.
Do you expect another tax bill January 26, 2026, which will attempt to get approval of certain tax law changes that were proposed in 2025, but removed from approved eventual 2025
Maybe
tax?
remove the date and just, is there discussions in the Hill about another supplemental bill with some changes?
So we originally thought, of course they're going to do it through a budget reconciliation, right? Because they're not going to be able to get the supermajority vote in the Senate. Originally, we thought that's not going to happen. They have so much going on. And they definitely, I agree with everyone, they're not going to get it done by the end of the year. But there seems to be some additional talks, even as of last week in D.C., that are really talking about this and talking about what they're mentioning. Senators had specific packages that they or tax reform that they wanted that they didn't get, and could that come into the second budget reconciliation bill? I think the Republican Party is also feeling a lot of pressure because when you've surveyed the general public, less than 70% of people are saying they received benefit from this last OBBA bill, and they really expected them to get help because of the significant changes they made. For those monitoring 199A, something that will be seriously discussed, right, in a potential budget reconciliation bill, which obviously doesn't help the federal deficit, but would be the increase of the 199A deduction from 22 to 23%. And for you, there's
Yeah.
a big item out there that you guys have been watching.
Yeah, there's the worker opportunity tax credit, the WOTC credit. It's set to expire, so it was not included in the original OB3 bill. And 12/31 is just a couple of weeks out. So there has been, I checked again, there's a bipartisan introduction, both on the Senate and the House side, November 20th. So we understand about 38 or so, perhaps on the Senate side, maybe have signed on to that in a bipartisan fashion, a little over 100 on the House side. That would extend the WOTC credit maybe from, if you're not familiar, that's a hiring-based credit for businesses based on targeted groups that you can receive that benefit back. You only have 28 days to comply. If it does go into hiatus, we do recommend people continue to screen because it has always been made retroactive. And by the way, this is not the first time it has expired. It has actually expired 13 times over the last 30 years. So
Not just
this
once or
is not
twice.
new. But there is
almost
a hope.
as many IRS commissioners this
That
year.
we had this year.
Right?
That's a good one.
But there is hope, and there's the federal, there's also the empowerment zones, which is another kind of where your workers are working and being paid. That's another credit set to expire, but we are hoping they will be picked up at least for a 2-year, probably a 5-year extension. Could be made permanent. Go back to OB3, had a lot of permanency in it. We're going to talk a little bit more about some of those other credits coming up that have been made permanent that were kind of hanging out there. So, a whole new bill, maybe picked up if they can in some of the appropriation bills that they got floating out there. I think they're going home after next week, so
Yeah.
we may have to wait till January. But they have 9 or so on the table, so to speak, that appropriations are trying to get done. But I'm just hoping the guidance will answer some of these questions too.
So out of the 9, I think 3 are funded till September 30th, but the big one that we're watching, obviously, is the funding of the IRS.
Which is not, right?
Which
That's
is
back
not
up again,
funded.
end of January, it's got to start all
January
over again.
30th, we're coming to another blow. And if you've read certain articles out by a variety of different accounting services, they're all saying like that could put the nail in the coffin in the IRS. We've been talking a lot about that, just the morale, the layoffs, the more complications to get a hold of someone, and just people not wanting to go back because of the how unsteady the job market is in government right now.
We continue to get a bunch of questions asking us to expand more on the tips and overtime. We probably predicted it, so you want to hit that last one?
Yeah, so who and how will the tax preparer know what is a voluntary tip? Will the employee actually know this?
Yeah, that's what I'm saying. It's a free-for-all for 2025. And
Not gonna know.
I think you have, for me personally, I
Use your
think
best judgment, or
I think you have to explain to your individual taxpayer, these are the rules, and then they have to provide you with a reasonable estimate because of that.
Employers have a voluntary requirement for 25, which means it's wide open.
Right.
In 26, now the definition changes, but that's the distinction in 25. You're going to do the best you can with what you get, and you do need to ask probably some basic due diligence if it seems way outside the norm all of a sudden.
Again, I would also just add, again, I'm a little bit more optimistic than some people. If you've got a good integration with some systems or apps, they may already be tracking it. And again, remember that reasonable methodology that's out there in the law. So, don't panic, just be aware that it's out there and it's coming. I do expect 26 will probably be a much tighter compliance, but I expect we'll have much more solidified guidance by that time too.
And I agree with you, but on 2025, I would doubt that any employer is going to give you anything.
Right.
Because then they're somewhat taking some liability for that.
If there's some software they're using that incorporates it, that's maybe a different
Yeah.
story, but you're going to be so reliant on your systems.
Yeah. And it goes back to the AICPA standards that we all know, love and know, that if we are getting data, we have to say, does it seem reasonable in order for us to be able to sign the tax return? And that's going to be part of it.
What else we got? Great.
Well, I like the question. This is because I like to talk about opportunities to get more money and have more relationships with your clients. So this question is, what's the greatest tax planning opportunity provided by the Big Beautiful Bill for SMB S Corps?
Small business corps?
Small business, yep.
S corps. Biggest planning opportunity for S corps. That's a hard one. I think there's a lot of benefits for S corps. I would just say overall, one of the sticky items that still remains out there that wasn't touched by OBBB was the excess business loss limitation. And so when you're driving, this is going to surprise a lot of people, when they're driving their 174 expenditures, their bonus depreciation, and therefore both those things might result in more interest expense being deducted because of the change in 163J and being able to add back depreciation and amortization. Essentially, if you drive that loss significantly high, you're not going to get the benefit at the S corporation shareholder level because of that excess business loss limitation. And I think everyone's agreeing, hey, everybody's saying they're going to pay less tax this year, but you have to be careful when you're doing your estimates to make sure you're not, over committing the loss that they're really going to be able to utilize. So that's something that I would focus on.
I would also just reference again R&D. It does work through on the flow through entity, so it'll flow through. Some of these other credits flow through on the K1s as well. So just be aware of that. So flow through entities are good. And before I forget, we didn't really touch on 179 and 179D, right? So if you are looking to or have been doing upgrades like to HVAC, LED lighting, things like that, where you may get a credit. Those are opportunities to go ahead and make those purchases and get those in. Before, because 179D is going to expire. So.
Yeah, and I would say just from a business perspective, there's a misnomer out there that a lot of the clean energy credits got wiped. Right. And I would say from an individual perspective, I absolutely agree. But from a business perspective, they did not. And so we still have a lot, not necessarily S corporations because there's passive and active risk rules, but we still have a lot of our C corporations transacting and buying clean energy credits to utilize on their tax returns for, a 7% to 8% discount. And so when you talk about paying $1 million in tax, that could be a significant cash impact.
And there's a light bulb going off with our small business clients where they just assume the more loss, the better. So we've been starting to have some conversations here just in the fall, explaining how this blends in, where's the right time to take it. And it's like a light bulb event. They're like, what do you mean I just can't add this up and then take it whenever I want? There's a complete misunderstanding by our clients out there of just how this goes. And it was a revelation for us of we need to be repeating this and breaking this down. And you've done such a great job today, both of you guys, of kind of laying that out. So.
Yeah. The other thing I would just interject for kind of that the smaller, medium-sized businesses is that employer-paid child care credit, right? So that's been significantly enhanced, also made permanent as well. So, I think it's gone from like 150 up to like 400, maybe 500 or more if you are a qualified small business, kind of using that 31 million. There's some aggregation rules, to think about. So any thoughts on that? I mean, because again, we're seeing that return to office a lot of times, and that's, there's been some 100,000 plus surveys say of child care workers that have left. So there's that need, if you're kind of having that in-office experience. So some businesses are looking at that.
When we were prepping, I wrote this down because one of the revelations for me that I need to talk to clients about is it's not about building this out in my firm. I can contract with another facility and qualify. So I can work with a local child care facility and offer that to my staff, and I don't have to build this out my own. There's a lot of assumptions. I think I was one of them, like, I got to be bigger and I got to build this into my building. And no, this ability to contract with a local firm who provides child care and then offer this to my staff and then share this with my clients, huge win. And it's just not been on our radar, and that's an opportunity for us, no doubt.
All right, we're going to take one more brief break to hear another message from our sponsor, ADP, and when we return, we'll display the third CPE code for this session.
Tax credits to help your business are great in concept, but the reality is that finding out what, when, and how to apply for them can require a great deal of research, tracking, labor, and documentation. Identifying appropriate and beneficial federal, state, and local tax credits for which your business may be eligible can be almost impossible without the right support. ADP Tax Credits is an intuitive solution that blends our intelligent platform with a deep domain expertise of dedicated specialists focused on helping your business maximize tax credit opportunities. With over 43 million work opportunity tax credit screenings performed annually, as well as proficiency and various employment, geographic geographical and transferable credits, and training and development incentives, ADP is a trusted name with additional SOC 1 and SOC 2 certifications, specifically for our expert tax credit services, from optimizing the tedious search and assessment process to auditing services that ease tracking and enable you to fulfill the identified tax credit filing requirements, to providing visibility to show your opportunity upfront, maximizing your potential tax credits before you sign any commitments. With ADP's personalized service and expertise, you can seamlessly identify and optimize available tax credits no matter where you are, what industry you're in, or what size of business you have.
Welcome back. We're going to display the third CPE code on your screen, and there's the bell. So be sure you're watching so you can write this down if you're planning on collecting either CPE or CE credit or both for this session. All right, what are we wrapping up with here?
Got a couple of miscellaneous items. I'll start with kind of the paid family medical leave credit that's out there. Again, another one that's been made permanent. You know, they've also kind of shortened the tenure on that, so you can go to 6 months. You don't have to be there 12 months. It is 12.5% of qualifying wages that are out there as well. You know, be sure you have a qualified written policy. You know, that's where we're finding some concern, you know, in some of our clients. You gotta have it written. It's gotta cover both part-time and full-time. You do have to work at least a minimum of 20 hours, so be aware of that too. But again, it's another good benefit, and we are seeing that, you know, in kind of a demand situation from employees, you know, and I think it's much needed. But anything y'all wanna kind of add on that aspect? So.
Michael, but 12.5%, but isn't there some ways to get it higher, up to as far as high as 25%, right?
Yeah, if you're paying more, I mean, you can incrementally increase that, you know, 0.5% and get up to maybe 50%. So
even higher. Okay, great.
So you can keep going. So on that, so.
And 12
well,
weeks.
excuse me, the maximum's 25%.
Okay, that's
sorry.
okay. Yeah.
But great point. So, and again, we're expecting more guidance on that. You know, I think they're prioritizing some things, at least as I saw the guidance. We saw RevProc, you know, 2025-28, which was the R&D and the expensing, because you only have, you know, until next July 6th if you're going to do those amended returns. And so we did see some come out, like on the tips and the businesses and everything. So it's coming.
It's coming.
Hopefully more will come sooner. So.
And I do want to have like a flashpoint on that July amendment date. The statute of limitations still pertains. And so to the extent that you filed your 2022 return before July in 2023, your date is actually 3 years from the original date in which you filed. So you can't wait till July. And I've been trying to shout that off the rooftops in our firm to make sure we don't miss any amendments, thinking we have until after busy season, right?
Because
when
not
we
everyone extends. Some people, and even if they extend, they may still file in May or June. They may not go all the way up. So that's a great point to know too. So
There was a couple updates just on our favorite ERC, employee retention credit, talking about, and from my world, it's extending the 6-year statute in the last 2 quarters, giving more time in that world as well. So I think ERC is going to be the gift that keeps on giving for a number of years. And this wasn't in the BBB, but I just want to make sure everybody out there understood that back in March, guidance was updated that allowed you to take any ERC and add it as income in the year received. You don't have to go back to the years of the wages and amend returns. That, I'll be honest, none of us in my world like that idea of having to go back. Yeah, there could be exceptions on penalties. State would do it, but IRS would, but you have to contact them, which is a challenge. So adding it the year, they need to make an estimate on that and going forward. So.
Well, I even think it was a bigger issue because I think some people, if you read the law, could interpret it that you were required in the year you requested it to not take the expense. So that's a huge relief for a lot of companies.
Huge win. PTET also. I think we were chatting off-sign about that. So thoughts on that?
Yeah. So PTET, what did that? I just laugh because they said they had an intent to issue proposed regulations, and you know it's 2025, almost 6, and we've seen none. We are anticipating hopefully something to be issued now, though, because of the fact that you know we seem to have come to a reconciliation that PTET will be in our lives.
And that is the pass-through entity tax.
Yes, pass-through entity tax. So the pass-through entity tax allows partnerships and S corporations to be essentially liable for their state income tax liability, therefore carrying it to the page 1 of the 1040 income tax return above AGI and not be subjecting it to a previously a $10,000 limit. We've got a lot of questions that came in and said, well, now the SALT limit at the federal level is $40,000. Can't, if your AGI goes above a certain amount, I think it's 500,000 married filing joint, you have to decrease it, but it can't go below 10,000. And so people are like, well, I'm only going to have 30, so maybe I'll just choose to do it the old-fashioned way. I just tell people, always remember that to the extent it goes on your Schedule A, it's an AMT add back, right? And so if you can still carry it forward on your page 1, then you're going to be able to avoid AMT. But also there's a lot of AGI limitations we've all been talking about through overtime and through a variety of things. And so to the extent that you can lower your AGI and still get into some of these benefits, taking it above the line and still paying the PTET amount at the state level still might be the right answer.
And it's funny in the bill that we were used to AGI being a limitation, but there was a lot in this bill with credits that the MAGI became the controlling number and not AGI. That was, in a different class I was part, we had like 12 different things that are out of BBB that were affected by MAGI. It was just to be aware of that.
Yep.
I know we got some, let's hit we'll probably run this out.
I'm going to let you
All right,
be a temporary moderator.
This is a team thing, right? As an employer, since it is voluntary, is there any liability for failing to provide this information and passing it on? I've not heard anything specific. Again, we're in the early stages waiting for information to come out. So no, there's no specific here, at least in 25.
Yeah, and I think the RevProc made it, really your responsibility would be reporting it on the W-2 appropriately. And they made it slam dunk clear for 2025.
They're not redoing that W-2.
Yeah, and you have no
26,
requirement. So for employers, that's probably a sigh of relief. For accountants, it's probably a wild, wild west scenario coming in the next couple of months.
Vaughn made a really good point, a few minutes ago too. Is you got to have that conversation now with your client to give them that reassurance, to give that there is more coming. So we don't just sit here and say we don't know, but we don't know till we get the guidance. But you can speculate, but there will be more guidance, maybe more legislation. We'll see. So
there could be some fear, and this is kind of reemphasizing the 25, take a deep breath, that we're really starting to really plan a lot of this for 26. So this tax season is not this looming deadline on a lot of these BBB things, and it's okay, we've got time. Michael, you've got some friends out here in the ADP world. You got a couple. Does ADP currently track overtime hours? I figured that was a nice easy
I do
one for
believe some of the time tracking systems will track that.
Okay.
So that's pretty. Again, the payroll systems are going to be up to date is my kind of general consensus that's out there.
Okay.
But you may want to double check, or if you've got an integration feeding into that, to be aware too. So.
There was a question out there asking us to come back and maybe spend a little more time on how the states are going to be looking at minimum wage and the tip over all these different things and the different rules. I know from a time perspective, we probably blew right by that, but is there any other perspectives you want to share? Based on that face, yes, right?
Yeah. Well, no.
We could probably do a whole day on that.
Correct.
So,
it's fascinating because I think so many people are excited at the Fed level. First of all, I want to go back to say a lot of people are saying I didn't receive anything because of this bill, because I've always had 199A. I've always had these benefits that are now getting extended or made permanent, and so they're not feeling it. Now, the add-ons are what the states are now saying, wait a minute, because if you change the federal AGI, that's changing what's coming to me as a state. What we've actually heard through the grapevine is a lot of the IRS people who are leaving are getting picked up by the states. Right. Because the states are ready to come now, and they're saying, well, we'll pay our people.
What a great point.
And so the states are being much more aggressive than ever before. But we've already seen certain states come out and say, we're not conforming with OBBA. And what you're going to find is a lot of the state legislatures are out. But unfortunately, and I know this is everybody's busy season, January is going to be a hot mess with states deciding whether or not they're going to follow all the OBBA, some of the OBA, none of the OBBA. And it's going to be hard to track. And so if you're a rolling conformity state, that means that you automatically, pick up what the Fed does. But oftentimes you can still have legislation that would separate yourself from that rolling conformity.
So Virginia is a rolling conformity state who already had a special session this summer when BBB passed and deconformed from BBB. So they are going to be having a conversation in January, just as you're predicting. But we were rolling conformity, but they clearly have already said not for the next 2 years.
Which means all the tax software is going to be have to be revised at the end of January.
So, I mean, if everyone's
And the
feeling...
forms.
And the forms, right?
I mean, if people are feeling a little overwhelmed and there's not a lot of information out there, well, we're all in the same boat,
Yeah.
right?
Yeah, right.
Yes.
We're all waiting for the same information. We all have the same questions. So you're not alone, is one of my parting thoughts. There will be more clarity to all this as time goes on, and less confusion.
Yeah, and I would say even with the first government shutdown, there was a discussion of will this impact an extended due date? And I know all of you, if you are in the practice, don't like extended due dates, right? Because it just prolongs everything.
Right.
But to the extent that we get another government shutdown, it's something to be monitoring that. It might be an unusual year that way.
Super quick, where are the places to go the next few months to get more info? What do you guys recommend?
Yeah.
CPA Practice Advisor.
I love it,
Yep.
right? Because it's going to be coming quick. We're going to be in tax season. We got a place to go. Answer is already. There we go.
What about communities keep coming up on a lot of these sessions? Is there a good community that people can go to for this kind of information?
Plenty of tax-related communities, and just follow tax Twitter on social media for one thing.
Yeah, I do get sometimes I get a little nervous with the tax Twitter because people are spitting out ideas. But if you're a seasoned professional, you know what works and what doesn't work.
And anything that's changing, they're going to be talking about it like crazy.
Yes, absolutely.
Or aren't we
true.
all learning from TikTok anyways? I mean, I thought this was done.
I mean, I've had people who write the bills say to me, "Are you following the tax Twitter?"
Yeah.
I'm like, okay,
It's X.
okay,
But tax Twitter is still tax Twitter.
It's still tax Twitter. That's still the day, right?
perfect.
Good stuff.
All right. Well, wow. Thank you so much, all of you, for an incredible session. I bet you're all out of breath who's been watching this because it's
and
a
furious.
lot of information to take in all at once. And there'll be more to come as the law continues to be updated, and should be an incredible tax season this spring. So thank you very much. Thank you, ADP, for sponsoring this session. We are going to be breaking till the top of the hour, so for like 5 minutes. And our next session, wait for it, is bringing entry-level staff up to speed on CAS. So that should be kind of fun. We'll see you at the top of the hour.
Hey accountants! You can generate even more revenue for your firm by referring your clients to ADP through the ADP Accountant Revenue Share Incentive Program. We are excited to introduce ADP's newly updated revenue share program for our research and development tax credit referrals. New for this revenue share program is a tiered structure for referrals, which incentivizes our partners who focus on growing together. There are 3 tiers, allowing your firm to earn up to 30% in year 1 and 20% ongoing for your referred business. Terms do apply, so be sure to review this information with your ADP partner. For your firm, this means delivering even greater value for your clients. The new tiers mean that as you help more clients, the benefits to your firm naturally increase. Plus, ongoing client success translates to continued revenue growth with year-over-year payouts. Finally, this structure helps ensure you're offering your clients the best-in-class support they deserve, thus strengthening your trusted advisor role. It is simple to get started. Just scan the QR code on your screen or visit us at adp.com/taxcredits-insuring. We look forward to partnering with you on this new opportunity.